And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Three of the best in the business today to talk about the ETF business. Of course, we have Tim Seymour from Seymour Asset Management, Kim Arthur from Main Management, and Deborah Fuhr from ETF Global Insight. The ETF business, folks, it just keeps rolling on, collecting more assets under management, assets invested in ETFs and ETPs, exchange-traded products, hit a record of over $7 trillion globally at the end of August. We're north of $4 trillion here in the United States, U.S., Europe, Japan, Canada, also at records as well. Deborah, tell me, what stands out to you as the biggest ETF trend so far this year?
Hey, it's great to be here. So I think one of the biggest trends is the fact that ETFs really busted the myths that they were able to handle the significant volatility in inflows and outflows during March and April. I think from there, what we're seeing is a significant increase in the number of investors using ETFs. So we see that there's nearly 6,000 institutions that hold just about half of all the ETF assets in 62 different countries. And when we look at where the money's going, I think we can see fixed income year to date has globally taken in 160 billion of net inflows, up from 148 last year. The Fed has clearly given a good signal to people that ETFs, fixed income, high yield, and investment grade are good investments. We've also seen equities where investors are looking for themes to play post-pandemic. So that would be ESG, technology, healthcare. We're also seeing active non-transparent. We have 15 new launches this year, gathering about 500 million so far. And gold has clearly played two different views there for investors. There have been 49 billion of net inflows. Some see it as a safe haven. Others see it as a potential and hedge against inflation, given all the stimulus going into the markets.
Yeah. And Kim, she brings up a very good point here, Deborah, that the volatility that we've seen has not resulted in any dramatic problems with the ETF business overall. You deal with a lot of investors. Does the fact that the ETF business again has handled a bout of volatility very well, even in bond funds, thinly traded high yield bond funds, for example, is that making institutional investors even more comfortable in using ETFs as investment platforms? Would that account for the fact that we're still seeing assets under management continue to increase?
Yeah, Bob, I would definitely agree with that. I think historically here, going back every time that we've had a volatility spike or disruption in the market for the last 20 years, ETFs have done a phenomenal job. They've done exactly what they're supposed to do with the price discovery. There's liquidity on both sides. It's not like the old days when you pick up a phone and try to call a dealer when bids were fading and the phone would just keep ringing and ringing and ringing. So they are doing exactly what they're supposed to do, and that's definitely why we are seeing institutional involvement continue to increase, like Deborah mentioned, with the 6,000 holding half of them. And high net worth individuals continue to move into them aggressively, too.
Yeah. And Deborah, just a quick comment, very quick on ESG. We keep seeing money pouring into ESG. It's really a sub-asset class by itself. And yet we've seen some pushback recently in the U.S., some people arguing that investment firms or advisors should not be pushing people into what are essentially ideological ideas. But that hasn't slowed down the money flows into ESG, has it?
It hasn't at all. And I think part of the difference is if you look at Europe, you see that the regulators are actually encouraging the asset owners, pension funds to invest along these ideas. And we are seeing that it's not just it's clean energy, it's social movement. So I think what happened with COVID, where we saw the climate really improve, we saw that social diversity matters. And we're seeing that some of it is thematic in the way people are investing. But I think the important thing is that companies that do better in terms of the way they treat their employees, in terms of governance, actually over the long run perform better. So it's not doing good to give up performance. You actually can find that these are tenets that are very important to have companies that are going to do well over the long term.